Hey everyone, I'm Kalita Farver. I'm a realtor in the Southeast Michigan area, Metro Detroit area with Powell Real Estate. And I am here today with my special guest, my favorite lender, Harry Pomitas. Hi Harry, how are you?
I'm terrific. How are you
Doing
today?
pretty good.
Thank you for having me today.
Oh, I appreciate you coming by.
Absolutely.
And for everyone who doesn't know who you are, can you tell us a little bit about yourself?
Yeah, my name is Harry Polomitis. I have an office with Mortgage One in Plymouth, Michigan. I've been doing mortgages for 24 years now and looking forward to it every day.
Every day, yes. I'm sure it's been a lot that you've seen over the last 24
No,
years.
no 2 days are the same.
I can believe it. And no two closings probably are the
That's
same.
correct.
So I feel like you would be the best person to answer some of the most Google questions, is what I found. So we can help people just understand mortgages a little bit better today. The first thing I want to ask you is, what is a mortgage?
Actually, the phrase mortgage, people think they're getting a mortgage, but they're getting a loan.
Okay.
And the mortgage is a document that is used to record the loan with the county to place collateral for the lender with the county. But I always was wondering what they don't want. I guess it's too boring to call it a note. I'm going to go get a note on a house, so they call it a mortgage. But technically,
Oh.
a mortgage is actually a document that's used to file with the county to place an encumbrance or a lien on the property.
That is very interesting. I didn't even know that.
Yeah.
So do they still do that? Like the paper form is electronic now?
With us, we have an option of doing what is called RON, where you can do 100% electronic filing
Okay.
or electronic closing. We utilize a mobile app for our loan process from application process through the closing, and about 90% of all of our mortgage documents are pre-signed prior to going into the closing. So they'll have 4 or 5 documents to sign in front of a notary. So the majority of the time spent at the closing is dealing with the actual acquisition of the mortgage, acquisition of the property, which is nice. They don't have to be bogged down with 2 inches full of paper that they have to sign.
Exactly. An hour worth of signing versus just a few pieces of paper is much
Absolutely.
better in the mortgage process. That's good to know. The second question is, how much mortgage can someone afford? How can they figure out that out?
Mortgage pre-approvals are based on your debt to income ratios, and obviously the higher that you earn, the higher you'd be able to qualify for a mortgage. But it all depends on what your income is and how much you're going to be able to bring to the closing table to purchase, whether or not you're going to get a loan to value of 85% or 90%, 95%. So it all depends basically primarily on your income level.
Okay. So what if I understand what you're saying correctly? First, it's going to depend on how much down payment they're bringing to the table, how much they're earning, and then how much debt they have, pretty much.
Correct. Primarily, one of the first questions I ask a client is because I want to design a loan program for them to provide them with a loan summary based on what their goals and objectives are instead of me just making some assumptions. A lot of times people say, I want to put $50,000 down on the house. Then I try to clarify that with them as to whether or not they want to put $50,000 down or bring 50,000 to the closing, because there's two big differences. Because if you put $50,000 down, you also have prepaid expenses and closing costs, which are added on top of the down payment. So 90% of the time when people say, yeah, I want to bring 50,000 down, they're really telling me they want to bring 50,000 to close. And
Yeah, that's all they have is the fifty
yeah,
thousand. They
that's
don't have
right.
the 50,000 plus the closing costs
Right.
and prepaid expenses. Okay, that's very interesting. Okay, so the third question I have is, what credit score do you need?
For conventional financing, you need to have a minimum of 620 credit score. For government loans, typically it's 580 is the minimum
Okay.
requirement, but obviously the higher your credit score is, the better off you're going to be in terms of pricing of your interest rate and being able to actually qualify for the loan. So that's primarily the credit score requirements. But obviously, the higher your credit scores are, the better off you're going to be all around.
Okay, so better for your interest rate, better for your down payment requirement, things like that.
And actual qualifying for the loan. Someone with a 600 credit score is not going to have a lot of flexibility with the system as to whether or not it's going to be approved or not. Whereas when you have a 780 credit score and I'm running the loan through the system, I'm going to have a little bit more flexibility in the system to be able to approve you. So,
Okay.
in other words, in some loans, I can qualify someone based on a certain set of circumstances at a 760, but if you had a 620 credit score, it probably wouldn't fly.
Oh, that's very interesting to know
So the
too.
higher the better.
The higher the better. Okay, that's a good. You heard it first here. The higher the better. Get it up as high as you can. Okay. And then the next question I have is how much do you need for a down payment?
That again, that also depends on the type of loan that you're going to be acquiring. Hopefully, your loan officer will guide you as to the best possible product that would be best suited for you. Typically, on conventional financing, you can go as high as 95%, meaning 95% of the purchase price you can finance with a conventional loan. If you're a first time home buyer, you can finance as much as 97%, but that's only if you're a first time home buyer. With FHA, you can finance 96.5% of
Okay.
the purchase price.
Oh, very good,
So,
very good. That's interesting because now speaking on that because people sometimes don't know what a first time home buyer is. And can you tell us what a first time home buyer is?
a lot of people think automatically that a first time home buyer is a person who's never owned a home before, but that's not necessarily the case. In the mortgage industry, you're considered a first time home buyer if you have not owned a primary residence in the last 3 years.
3 years, that's it?
That's correct.
Oh, that's
So,
amazing. So a lot of people can qualify even though they didn't, maybe they owned a home in 2000, the crash of 2008, and they haven't owned a home since. They can now qualify as a first time home
first
buyer.
time home buyer and possibly get into some down payment assistance as well.
Amazing. That is
Yeah.
amazing. That's good. That's good news for a lot of people, including myself, I think, as far as it has been over 3 years for me. Next is what is private mortgage insurance?
Private mortgage insurance is an insurance policy paid by the borrower that basically benefits the lender. When you borrow more than 80% of the purchase price of the home, for example, you buy a house for $100,000. If you only borrow 80% or $80,000, there is no mortgage insurance required. But if you borrow anything more than the 80%, then it's required of you to get an insurance policy that in the event of a default, the difference between the loan amount and 80% will be covered by that policy to protect the lender.
It's like gap insurance,
It's heavy gap insurance.
heavy gap
Yeah.
insurance. Okay.
And again, the two main criteria for the cost of private mortgage insurance, which we have, I think, 8 different companies that we quote through at this. We do simultaneous quotes with all 8 companies, and it's basically based on 2 criteria, and that is the zip code that you're purchasing the property, and then also your credit score. And the credit
Again.
score is coming around.
The higher the better.
The higher the better.
Right.
And it does make a significant difference on the cost of the mortgage insurance. What's nice about mortgage insurance, though, which most people aren't aware of, is that with conventional financing, once you can document that you have attained an 80% or your equity is at least 20% of your home, after 1 year, you can request to have that mortgage insurance terminated.
Oh, that's very interesting. So you don't have to refinance to get it removed. You can just
Not
refinance.
on conventional, but on FHA, you do. FHA, they don't call it private mortgage insurance. It's a mortgage insurance premium, which
Okay.
you pay to pay to HUD. And mortgage insurance with FHA stays perpetually.
Oh, okay.
So if you
Gotcha.
want to get rid of it, you have to refinance it.
So refinance for FHA, for conventional, just call and request it. Okay. That's good to know. See, that's good to know up front so you can know which one is to choose if you can.
Absolutely.
And then, okay. So the next question that I see here is what are closing costs?
Closing costs are fees that you have to pay to the lender and third parties to be able to consummate the transaction. You're going to have an appraiser, which is a third party cost, which is a closing cost. You have title fees, closing fees to a title agency, and then you have loan costs. You have miscellaneous fees such as the cost of credit reports, verification of employment, and it all comes to be a substantial amount of money sometimes on the situation.
Yeah.
But those costs are necessary, but typically you're only liable for those costs in the event that you close the transaction. For me, we have an exception. I typically like to collect the money for the cost of an appraisal because if I have an appraisal conducted for a purchase and for one reason or another, the transaction does not close, we still have that cost. It's a hard cost, it's not a soft cost, as opposed to title insurance. You can get a title commitment from your title company, but they're not going to charge you for it until you actually close the transaction.
Oh, that makes sense too. Yeah, and a lot of deals, especially at the appraisal, sometimes they can fall apart at the appraisal.
That's correct.
Yeah, if it doesn't appraise for the amount that they're asking for.
Absolutely.
I've worked through quite a few of those, so I definitely know. So hopefully, I haven't had that situation, and hopefully, I never have it. But I know that it can be very something that can kill a deal is the
That's correct.
appraisal. Yeah. And the next question I have is, how long does it take to get a mortgage?
It depends on several different factors. One, how well equipped the borrower is in terms of being able to provide the documentation that's needed to get the loan completed. But also, we're relying on third parties. We're relying on an appraisal to be completed, reviewed, and accepted. We're waiting for a title commitment to come in to be reviewed and accepted. And also, we have the underwriting process of the loan. And typically, the standard amount of time for a comfortable amount of time to close a transaction under contract on a purchase is 30 days. Now, there are on occasions that people come to me and say, look, I have a loan that's got to be done, but we have to have it done in 2 weeks. Can you do it? And I've done it before, and I'll do it again if the situation arises. But we've got to put a top priority on it to be able to get it to close. Now, sometimes I've had some where it's taken 45 to 60 days to close because there's issues with the property, or there's a delay in the appraisal because repairs have to be done, and so on and so forth, and it could delay the process. Not necessarily because of the lender, it may not be because of the borrower, it could be because of third party or situations outside the control of the lender or the borrower that's going to delay the transaction.
Yeah, that's good to know. Yeah. I know a lot of times I normally 30 to 45 days is what I've always try to assume. I know I have personally asked you to complete it in less than 30 days.
Absolutely.
And I know you've done your best to get it under the 30 days, which you have done before, so I can definitely vouch for that. It's just that I know that it's a lot of variables in there.
Sometimes that can make a big difference. The market is very tight right now, and it's a seller's market. And sometimes the ability to be able to close a transaction real quick may be very appealing to the seller, and may go with your offer as opposed to someone else's offer, that in the event that they need to close in 21 days or 19 days. And if you are able to commit to that, then sometimes you can win over an offer above and beyond someone else's, because there can be multiple offers on a property. So,
That's a good point, because I've had that where sometimes it's simply waiving an appraisal or closing in a lesser time than anybody else that gets you over the edge.
absolutely.
Things like that in the seller's market make a big difference. So to say that the lender definitely makes a difference in the negotiation process as well for your real estate agent, just so everyone knows for sure.
Absolutely.
All right. And okay, so for the next question, I want to know, what is a fixed rate mortgage versus an adjustable rate mortgage?
The difference between the two is a fixed rate mortgage is a rate in which stays constant throughout the life of the mortgage. So if you get a 30-year fixed rate at 6.5%, it will always be 6.5% throughout the whole process. And your loan amount, principal and interest, will never change. The only thing that may change in your monthly payment is your taxes and insurance, whether or not they go up or down. And usually it's the first. They normally go up before they go down. An adjustable rate mortgage the interest rate is adjusted based on the LIBOR rate, and whether or not the LIBOR rate goes up or down, they will adjust every 6 months. And usually it's fixed for 3, 5, or 7 years, and then after that time period it's expired, that's when they start adjusting it, whether it be on a 6 month or a 1 year intervals.
Okay, I've heard the 357, so that's what that means. It could be 3 years, 5 years, or 7 years on an adjustable rate mortgage.
Yeah, but they would be fixed for the 3, 5, or 7
Three,
years. So let's
fixed.
say you
Okay.
get an adjustable rate mortgage at 5%, and it's a 5-year adjustable rate mortgage. It's that rate for the next 5 years, and then after the end of the 5 years, every 6 months or every year, they would make a pricing adjustment on the interest rate depending on the market.
So that could work for you and against you, kind of.
Yeah, but right now in today's marketplace, adjustable rate mortgages are not much different in rate compared to a fixed rate. So why go with an adjustable when you are not certain as to what your future payments are going to be over the next 30 years? Just stick with the fixed rate.
Okay,
I
that's a
don't
good.
think I've done an adjustable rate mortgage in at least 5 years.
That's good to know.
Yeah.
Yeah, because I've heard some people say they got an interest only for the first 5, 3, 5, or 7 years, and then they get that balloon payment after a while with the interest.
Yeah, they were doing that back in '08 and '09, and a lot of people ended up foreclosing because they qualified them based on interest-only payments, and then when they had to start making principal and interest payments, they couldn't afford it, and that's a problem child down the road.
Oh, okay. Okay, so that's good. So that's part of. So they've changed those rules since.
Yeah, adjustable rate mortgages are not popular these days. They were at one point in time, but adjustable rate mortgages are not very competitive price-wise.
Gotcha. Okay, that's very good information. I didn't know. I didn't know not even the history of it. So that's good to know. Okay. So my the next question we have is what is refinancing and should they do it?
Well, refinancing of a mortgage, there are several reasons, basically two primary reasons as to refinance a property. There is two types, and that's called a rate and term refi, where you're refinancing just to improve the rate. And then there's also a refinance where you want to take equity out of your home and you call it, it would be deemed a cash out refi, where you refinance your first to either improve your rate or B, to refinance to hopefully improve your rate and pull some equity out of the house. Now, when you're pulling equity out of the home, interest rates are not as attractive as a rate and term because you're leaving all the equity in the home.
Oh,
So now the way I look at it in terms of refinances, if you're going to save X amount of dollars per month with your new mortgage, you take that monthly savings and determine how long is it going to take for me to recoup my cost of that refinance by the amount that I'm saving every month. If you're going to recapture that cost within 15, 18 months, it's a great deal. But if it's going to take you 7 years to recoup it, it's not. So that's a gauge that I use to see if it makes sense. Sometimes people refinance not primarily for the cash flow purposes, but they need to pull equity out of the home, which in today's marketplace, people are better off just getting a small equity loan if they need $20,000 or $30,000 and keep that first mortgage with a low interest rate.
okay.
Because if you have a low interest rate and you need 20 or 30,000, usually the only person that really benefits from it is the lender, because your payment's going to skyrocket because you have that nice low interest rate, and now you're going to go into the current market, which is much higher.
Okay, that's good to know. I didn't know it was two different rates based on if you were taking out cash or not, or just refinancing. That's or just a interest or rate only refinance.
Correct.
A last question I have is what are points?
A point is in the event when you're getting a mortgage, you're going to be offered a rate based on the current market. And let's say today, if I was to lock in a loan for somebody, let's say the rate is 6.5%. And they may say, what can I do to reduce the rate? And to reduce the rate, you can pay points whereby you pay at closing to buy down the rate. You can do a permanent reduction, or you can do basically what you'll be doing is you'll be paying a cost to reduce your interest rate. And again, it's like a refinance where if it's at 6.5% and you pay X amount of dollars to get it at 6.25%, you look at the savings between 6.5% and 6.25%, how much you're going to save per month, and compare that to the cost to do that buy down. Again, if that cost is going to take 60 months, it's probably not a good move to make.
That goes back to the question I had you about refinancing. So there is a cost, like a cost associated with refinancing as
Yes,
well.
you don't have as many costs as you do on a purchase, but typically on a refinance, depending on a situation, the cost could be a lot less than a purchase. I just locked in one today, and when we ran it in the system accepted the value that we determined the home to be worth. We estimated the home to be worth, it was $525,000, and usually the appraisal can be up to $500, $575 to get an appraisal done. When we ran it, the system says we accept your offer. Because you have to remember the last 10, 15 years, every appraisal that's been done for Fannie Mae, Freddie Mac, and Ginnie Mae have been documented.
Oh, that's
So,
interesting.
so they do a automated valuation when you're getting your loan approval through the system, and they'll determine whether or not that value is sufficient to do the loan without an appraisal.
That's interesting. I didn't know they could do
Oh,
that.
yeah, they're really nice. Plus, it saves the borrower $500.
Yeah, that's a big savings.
Now, on the contrary, I'm doing one right now, a condo in Ann Arbor, have an appraisal waiver, but he still wants an appraisal.
Oh, wow.
He still wants to know what the true value of the house is. But the only downside to that is if, let's say it's $500,000 purchase, and he's financing based on 500, and the appraisal comes in at 450, I can only finance a percentage of the 450 because it's always a lower a purchase price or fair market value.
Oh, wow.
But I don't think in his scenario, I don't think it's going to be a problem at all,
Okay, that's
value
good.
wise. Yeah.
Yeah, because I was going to say, wouldn't that work against him? And could he just wait till after the closing to
Well, it
get
could
appraisal?
hurt them, but some people prefer to just have it a level of comfort and not wonder, did I pay too much for the property?
Oh, okay.
But if the lender is going to give you an appraisal waiver, that's a pretty good indicator that what you're buying is worth it.
Okay, got it. Okay, that's good to know. And before we go, I know that there's different kind of loans. If you, just for people who are new to this and nervous and they don't know what's out there, what are the different kind of available loans for home buyers?
There's several types of loans. Fannie Mae and Freddie Mac, they provide conventional financing. And then the government also has government subsidized loans, which is FHA, VA loans, and rural development loans. Those are the five primary. There's some specialty products out there, 203K renovation mortgages that is funded through FHA. But typically, 90% of all the loans that I do are either FHA or conventional.
Okay.
And the difference between FHA and conventional, and to keep it real simple, conventional financing is either a yes or a no. Either you're going to qualify or you don't. On FHA, they have a little bit more lenient for people who otherwise cannot get a conventional mortgage, but they're still have the credit worthiness to be able to get a mortgage, and it would be subsidized through FHA.
Okay.
In other words, people who have conventional loans can get FHAs, but not all people who get FHAs can get a conventional loan. So,
Oh, so you have to be a little more qualified to get the conventional.
correct.
Okay.
Conventional loans is very heavy credit score driven,
Okay.
and it's not as much with FHA.
Okay, got you. Okay, that's very good to know. Thank you for joining me today here.
Absolutely, this has been fun.
Yeah,
I
I
enjoyed
greatly
it.
appreciate it. And if you have any needs, real estate needs or mortgage needs, you can reach out to Harry or myself, and we'll definitely be able to help you. You have a great day.